Hello guys and welcome again to my channel. So we are already at step 8 of the accounting cycle for merchandising entities, which is the preparation of the closing entries and posting them to the ledger. Okay, let's go to step 9. So on the step 9, you are just to prepare a post-closing trial balance, and it's very easy. Okay, what do? We just have to list the new account balances here in our ledger. So in our ledger, we have already posted the general journal entries without the adjustments. So we have three balances here. We have the first one, the unadjusted balances. So we did that already. And then after the adjusting entries are posted, we have the adjusted balances. And the third one, after we post the closing entries, we have the balances after the closing entries. I do not know what do you call that. But let me tell you again, there are three types of balances in our ledger already. Okay? So, because of that closing entries, adjusting entries, the balances here are already coincided with the balances in the financial statements. If you can remember, we have made financial statements on step 6, right? So, all of the balances there is already coincided with here. Okay? So, for example, in the statement of changes in equity, of course, the equity is now the same with this one. Let's say equity 1718950. Okay? And then, if you go to the statement of financial position or balance sheet, these are the accounts that you are going to see there. Okay? So right now, let's make the post-closing trial balance after the closing entries are posted. I hope this could be erased immediately. Just wait for me. Okay? Oh no. It's a little bit slower than I anticipated. Yeah. So let's make the post-closing trial balance, shall we? So you'll start with cash. And then we have debit here. And then we have credits here. But there is still, what do you call this? A header, post-closing trial balance. And above it would be the company name and then the logo if ever. But here, I'm going to go directly. I'll just posting. I'll just write here in the left side. So we have the cash, 763,450. And then we have the accounts receivable. We have 387,000. And then we have the merchandise inventory. It's already 453,000. We have the supplies. Supplies is at 7,000. We have the insurance advances. 46,000. We have land at 370,000. We have office building. The office building is 900,000. But then again, there is an accumulated depreciation for that office building. So, you should put it after the office building. Okay? Where is it? Accumulated depreciation of his building is 250,000. 253, I guess. 253,000. Insurance advances, let's take a look at it. It's 46, right? And the land is 370 and the office building is 900. And then after the office building, where is the office equipment? Yeah, the office equipment is 800,000. The accumulated depreciation office equipment, the accumulated depreciation office equipment is 200,000, 204,500. I need to be careful. And then after the office equipment sales, discount freight out sales returns and allowances purchases, freight in interest expense representation, drawing salaries expense which are already reduced to zero, insurance, depreciation, supplies, merchandise inventory beginning in the income statement, they are already reduced to zero. Now let's go to the credits, so liabilities. So accumulated depreciation, we've done it. Accumulated depreciation equipment, we have already put it right here. And the accounts payable. Accounts payable. Accounts payable is 277,000. And the loans payable is still 1,200,000. Is that it? I guess there is still another one. Oh no. It shouldn't be loans payable. It should be salaries payable next. Because again, salaries payable and accounts payable are current accounts, current liabilities, 73,000. And we have the loans payable, 1,200,000. So after that loans payable, we have, let's say, equity. The last one, actually, because all other else are reduced to zero already. The last one is 1,718,950. So supposedly that is the last one, but let's check. So we have to be perfectionists. We have to see if ever we skip an account purchase, discount purchase returns, sales has been reduced to zero, merchandise inventory end, as well as the income summary has been reduced to zero. I'm so sorry about this. Let's erase this so that Office E, you know that it's already an equipment. So the trial balance, the post-closing trial balance is a little bit shorter than what it used to in the adjusted trial balance and the unadjusted trial balance because all of the temporary accounts are closed. Again, the temporary accounts are the income and the expense accounts or the revenues and expense accounts. And you already know why they are called temporary because at the end of each period, you have to close them and you have to make closing entries to close them. Okay? So, let's check if ever the debits and the credits are balanced. So 763,450 plus 387,000 plus 453,000 plus 7,000 plus 46,000 plus 370,000 plus 900,000 plus 800,000. we have 3,726,450. And then 253,000 plus 204,500 plus 277,000 plus 73,000 plus 1.2 million plus 1,718,950. 3,726,450. 3,726,450. Okay? Okay. So let's go to the step 10, which is the reversing entries. So since this is already the last, let me tell you that the reversing entries is very easy to perform because you just have to look at the adjustments, select from the adjustments, and then you reverse the adjustments. Okay? So meaning what was debited will be credited, what was credited will be debited. That's as easy as that, the reversing entries. I guess the timing is also um, the timing of reversing entries is also easy to remember. That is the beginning of the next period. Like for example, if you are making adjustments every month end, so meaning in the next month, Jan- in the next month, the first day of the next month, you're going to do some reversing entries. But if you are adjusting at the end of the year only, like for example, January 1 to December 31, you are making adjustments at December 31. Of course, you have to reverse it on January 1 of the next year. So again, reversing entries are made at the beginning of the next period or next year. Okay? So that's all for reversing entries procedural. However, we have to explain why is it that the reversing entries are needed. Okay? So why is it also in selected adjustments only? So first off, let me explain like this. So since these are old, the logic of the reversing entries again. I guess I have already talked about the logic of reversing entries in the service entities, but I'll repeat that as if you did not remember it again. So one of those adjustments that are to be reversed are related to the adjustments related to those adjustments from deferred as deferred expenses, not deferred asset, deferred expenses. In other terms, prepayments or prepaid expenses. Okay? So those are the deferred expenses using expense method. So only the adjustments for prepayments using expense method are reversed. Okay? So what does it mean? Something like this. For example, we are at October 1 of the year, October 1, 20x5, something like that. You have paid for rent for 6 months. 6 months rent. And the rent is about 100,000. To make it easier, 100,000 per month. So you paid for here. So if using expense method, that will become rent expense immediately. Rent expense, 600,000. Because again, 100,000 per month. So using expense method, any advance payment that you pay will be recorded as an expense, right? So rent expense 600,000 and then credit cash 600,000. Here comes 1231, the end of the period. So some would say that this is the adjusting period, right? And we are going to say that this is not true. We have not used the whole 600,000. October, November, December only, 3 months only. We have only used 3,000, 3 months or 300,000. So what will happen? You have to reduce the rent expense by how much? The 300,000. Because we only use 300,000. So if you have an entry like this, rent expense 600,000 and then you are going to credit 300,000, then it will already be appropriate. The rent expense is 300,000. Okay? How about the debit? You are going to establish prepaid rent or an asset, 300,000. That's the expense method for prepayments. This is the adjustment. Okay? According to our step 10 now, if it is already January 1, 20x6, you have to reverse it. So you have to reverse rent expense 300,000. You are to debit because it has been credited here, and then credit prepaid rent because it has been debited here in the adjustments. Why is it that we need to reverse? Not really need. Why is it? Yeah, let's use the need. Why is it that we need to reverse? Okay? Because if we will not reverse, as you can see, from 10/1/2025, we used expense method. So meaning any prepayments should be recognized as expense immediately, right? And then at the end of the year, you have to establish the unexpired or the unused, which is this one, the prepaid rent. Okay? Now, if you will not reverse it, the expense method has already been converted into asset method because you're already using prepaid rent when supposedly you have to use when you pay in advance. If you're using expense method, expense immediately. Okay? So from expense method, it becomes the asset method because of this prepaid rent, establishing of the prepaid rent. Now, if you don't reverse it, it will continue to be an asset method. And it will be a violation of your accounting policy. You understand? So, as you can see, when you reversed it, the prepaid rent became zero. We have rent expense. The rent expense has been reestablished at 300,000. That's it. You have to reverse deferred expenses using expense method. The adjustments. Let me emphasize. What are you reversing? The adjustments. The adjustments for prepayments that are using expense method. Okay? So that we will be able to preserve the expense method in the next year. Because if we will not, the expense method has already been converted to the asset method. It will go on as asset method already if you are not going to reverse. Okay? So that's the logic. So number one, that is to be reversed, the adjustments of prepayments that are using expense method. Okay? Next, we have the item number two that are to be reversed. The item number two that are to be reversed is the deferred revenue. Adjustments, let me emphasize, the adjustments only of deferred revenues. These are cash advances from customers, basically. Cash advance from customers. However, those that are only using revenue method. Why? According to here, let's go back to the deferred expense. If the prepayments is using asset method, there is no problem at all because the advance payments that you will give is recorded as an asset, prepaid rate. And then, afterwards, at the end of the year, you have to recognize the expired. So it's okay because the prepaid rent minus the expenses, the remainder will still be prepaid rent. There will be no issue on the next year because the remaining prepaid rent will be expensed at the adjusting period, something like that. There will be no changing of the method. Unlike here, from the expense method, because of the adjustment, you have recorded the prepaid rent, which is not really true if you're using expense method because usually you're going to record always expense and you establish in the last or the adjusting period the unexpired. The same is true with here in the deferred revenues. So if the deferred revenues or cash advances from customers has been recorded initially at liability method, there will be no problem. There will just be problem if you're not going to reverse the adjusting entry for the deferred revenues using revenue method. Okay? For example, still, it's 10/1/20x5. A customer paid 100,000 for 12 months. 100,000 per month for 12 months. So what did you record? Under revenue method, you recognize that immediately 1,200,000, the cash that you have received as revenues. 1,200,000. Okay? So, for example, it's now 12/31/20x5, the adjusting period. You will say that this is not really true. You have not earned 1.2 million. You only earned for 3 months, October, November, and December. So that's 300,000. So what will you do? You have to debit the revenues by 900,000 because the 900,000 is still unearned. So deferred revenues under revenue method is considering all cash advances from the customers as revenues immediately. They are just going to recognize the unearned on the adjusting period or at the end of the period. Okay? So usually it is recognizing cash advances from customers as revenues. Okay? So what will happen if you're not going to reverse on January 1, 20x6? Your revenue method has already been converted to the liability method because of your establishment of the unearned revenues, which is not usually used under revenue method. Okay? So you have to reverse it in order to go back to revenue method. So you have to debit the unearned revenue of 900,000 and you put that back to revenues. Again, you only use the unearned revenues at the end of the period or the adjusting period. That's it. That's the logic. And in our particular problem, let's go to our particular problem. Only one is to be reversed, and that is the reversing of the salaries. I Yeah, 73,000. That is the number three to be reversed. The accrued expenses. And number four is accrued revenues, by the way. So there are four types of adjustments that you are going to reverse only. So we have the accrued expenses. So the accrued expenses, as if I can still remember that salaries expense, salaries payable. Accrued expenses as a pattern of this one, expense and then credit payable. That is our adjusting entry on 12/31, for example. Yeah, It's 1231.20 x 5. On the reversing, you have to reverse this into debit salaries payable, 73,000, and then credit salaries expense, 73,000. That's it. So why is it that some are using reversing entries? It's okay if ever you are not forgetful. It's okay if ever there are few expenses that are considered accrued. For example, we have only salaries expense. You can remember that salaries expense, salaries payable, 73,000 has already been recorded in 1231.20 x 5. On January 1, 20 x 6, you don't need to reverse because your entry will be salaries payable credit cash, 73, which is proper. So, if you can analyze, there is a proper recognition of expenses. The expenses was recognized on 12/31/20 x 5, and on 20 x 6 there is no expense already. That's proper because the expense was incurred last 20 x 5. Okay? However, if you are forgetful, so if there are a lot, let's say, if you're forgetful plus there are a lot of accrued expenses, not only the salaries expenses, we have utilities expense, a lot of expenses actually. You will forget to use this. What will you do if ever you forget this 73,000, especially if ever we have a lot of expenses accrued on 12/31/20 x 5 and they have different due dates. So if you forgot, your entry might be salaries expense, credit cash, 73. If you forget, is that wrong? Yes, it's wrong because you have recognized the salaries expense last 20 x 5 and you will double recognize the expense here now on 20 x 6 on the next year. So the income statement for 20 x 5 reflects the salaries expense of 73,000, and in 20 x 6 it will also reflect the same salaries expense of 73. That is a violation of proper cutoff. Proper cutoff is, it meant that the transactions that are for the current period should not be recorded already in the next period or in the past period. That is the meaning of cutoff. Transactions are recorded in the proper period. Okay? So that is already a violation because there will be a duplicated salaries expense. Do you understand? So that's why if there is reversing entry, this will not be a problem. As you can see, salaries expense, salaries payable. There are a lot of accrued expenses. However, you decided to reverse it. So salaries payable, salaries expense, you have only reversed the entry. Even if you forgot, you entered the salaries expense 73 and credit cash 73. The salaries expense will be correct. The salaries expense has been recorded in 20 x 5. The salaries expense has also been recorded here in 20 x 6, 73,000. However, it was negated by the reversing entry. See? There is debit, there is credit. There is no problem. Do you understand? So reversing entries are actually optional. Those things, it's actually optional. As long as you can remember that your accrued expenses are like this, so you have to debit payables. The adjustments for your deferred expense using expense method and revenue methods are like this. So you will have a proper entry on January 1 or in 20 x 6 or in the next periods. Okay? However, I would recommend that you do reversing entries because it has helped me a lot uh, when when I'm in my accountant life. Before the teaching, I've been an accountant. So reversing entries helped me a lot. Okay? And the fourth one, the accrued revenues, in which in our particular problem we don't have any. Again, in our illustrative example, only one adjusting entry is eligible for reversing, and that is the salaries expense. Why is it? We have supplies there, we have insurance advances, but both are using asset method, not expense method. So we are not going to reverse them. Again, the number 4 that is to be reversed, let's use this, is the accrued revenues. Accrued revenues are revenues that you have already earned but you have not yet been paid. Okay? So the customer is late in payment. So earned but not yet collected. So for example, on 12/31, you have a customer and you have rendered services worth 300,000. So meaning you will have accounts receivable and then revenue 300,000. Okay? So how do you reverse it? Revenue, accounts receivable. The same uh, justification for the accrued expenses. For example, you are not forgetful, so you don't need to have a reversing entry because when you collect your entry on 20x6 will be debit cash 300, credit accounts receivable 300. That's proper. No reversing entry because you do not forget. However, if there are a lot of these, a lot of customers, a lot of accrued revenues, and sometimes the due dates of those receivables are not the same. So meaning the customers are paying in different dates. So what will happen? You tend to forget sometimes. Like for example, they pay on July 1, 20x6. On the next year, you tend to forget. Okay? So what will happen? So on 7/1/20x6, there is somebody who paid. You're going to debit cash still because there is cash involved. However, you're not going to credit accounts receivable. You're going to credit revenue. And that's a problem. Okay? That's a problem because you recognize the revenue already in 20x5. And then you recognize again in 20x6. That is a violation again of cut-off. Okay? So what will happen? That is a duplicated entry. And what will happen is that the revenue will be bigger because you have recognized the revenues twice, and then the accounts receivable will be bigger because you have not recognized payment of the accounts receivable. So what to do if you are forgetful and there are a lot of transactions? Instead of remembering it, it's okay to have this entry so long as your accounting policy is to have reversing entries. So you see, if we reverse the revenue, 300,000, and accounts receivable, 300,000, the entry will be perfect. You recognize the revenue at 300,000. You tend to recognize because you are forgetful also in 20x6 the revenue. However, that recognition has already been negated on January 1, 20x6 by your reversing entry. So it's okay. It's less stress. Alright? So that's the purpose of reversing entries. But if you're confident with your memory, which is I guess not true to all of us, then do not use reversing entries. It's optional. Okay? So that's it for this video for the illustrative problem. And then I have already shown you the step 1 to 10 of the accounting cycle. So majority, you're already well versed with merchandising and service entities. Although, in order to finish the foundations and in order for my dreams for you in getting the TESDA NC3, for example, or certified bookkeeper, I would have to have special episodes related to internal control, related to some other topics related to merchandising, like the ones that we are talking about right here is the periodic inventory system. We have perpetual inventory system. We're going to talk about that in the next meeting. And then parts of the internal control and the forms that you actually use when making journals, what is really the ledger, manual ledgers, and the worksheet, and the subsidiary ledgers, and etc. That would be on the next episodes. Okay? So thank you for watching and see you on my next one.